Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, so now we're going with a similar setup. We're still selling the 730 straddle, right? 730 calls and puts. But this time we're going to buy the 710 puts and the 750 calls instead of the much further out strikes as was explained before. So we're tightening up. Instead of being 80 points wide, now the strikes are only 20 points wide. That's a significant difference. Well, how is that going to affect my trade, right? Because remember I said three-legged stool: risk, reward, and probability. So that we have the numbers here, the potential credit we're looking to collect here is $16.20. So that's roughly, it's a little less than half of what we were looking at before. And here is just another screenshot of what that trade setup would look like. Now the max loss here, though, because the strikes are so much more narrow, the max loss is only a function of $20 less the credit received of $16.20. That leaves us with a max loss of $3.80. That is a huge improvement. Huge. Okay, but we all know that there's something we're going to give up here, right? We're getting a completely favorable item of being able to, the possibility of being able to make a lot of money, as well as reducing, as well as the possibility of losing the amount of money has shrunk enormously. So just to convey this visually here, this is what we're talking about. So here is the narrow butterfly with the short strikes still at 730, but the long strikes much closer into the at-the-money strike. And you can see that the distance traveled down here is much less than the distance you have moving up to the upside of the profit of $1,600 or $16 per contract. When you contrast that here, the distance from the zero line up to the max gain or the zero line down to the max loss, much wider. Also, it's 1-to-1. Again, that is the 40-to-40 ratio we talked about before. When you compare these numbers here for the narrow butterfly, the reward to risk ratio, which was 97% before, now it's 420%. Well, what does that mean? That means that if we were to make the maximum for this trade, which was $16,000, we would use $3,800 in which to do it, right? That's how much capital you need to do this trade. If you were actually successful for the maximum, you would make 420% on the trade. That's a return on investment calculation. Now, of course, you're not going to make that amount, right? That is just the maximum that you could make. And so what we need to do is we need to contrast that number with the probability that we actually will make that amount, okay, or make any amount, and then compare that whole picture to the butterfly from before. So here we are back to the probability calculator, and what I've done is I've again entered in the break-even points from our new trade and entered them in here. I hit calculate, and it gives me this percentage here, again, of finishing between the target prices. And the target prices for the new trade was roughly 710 and 750, or 713 and 746. Okay? So the chances of the underlying finishing between the strike prices that I need in order to be profitable between now and 51 days from now, which is expiration, that probability has given me 21%. okay? So the probability of making money is now only 21%, whereas on the previous trade it was 51%, okay? So what we're saying here is there's a much lower chance we're going to be successful in this trade. But if we are successful, we have the chance to make a lot more money than how much money we have at risk. So what we're getting for a more favorable risk to reward scenario, we are giving up in probability of success. From the previous trade, we were having even risk to reward ratio for a higher chance of making a profit in that trade of 51%. Here it's much lower at 21%, but in exchange for the lower probability, we are risking far less money with much higher upside in proportion. Well, for narrow butterflies, so you have the perspective, this is characteristic. This is what you end up seeing a lot. Okay? In this case, because you have much less at risk, the risk management is a lot less important. So you may hear people not really talk about adjusting butterflies. Now that doesn't mean risk management is not important. It just means that these trades tend to be a lot less expensive when compared to a wide butterfly, which is much more expensive. And again, that's been reduced because the strikes are much more narrow. The distance between them has been covered, has been diminished. Excuse me. But on the other hand, the probability of reward is low, and that is also characteristic of narrow butterflies. And as I mentioned, it's a 21% chance to make at least something up to the 420% return, which would be the maximum, but is nearly impossible since you only have 21% chance of being successful. Now, another item here that I alluded to before is that when you're trading FX options, you need to be considering special factors that drive a country's currency. And it's not just that country's currency, it's the U.S. in relation to how it performs to the U.S. currency or some of the other pairs that are out there. But that is definitely much more complex. So, keep in mind these items will play in and affect your trade. What's going on in both countries as far as the economic outlook, their trade policies, unemployment, interest rates, politics, inflation. The list is quite long. So, you definitely want to have a handle on what is going on in the countries that you are making a play, because that's going to affect the performance of the underlying security. All right, so to sum it up, again, here's the summary for the Iron Condor. And here is the same for the wide butterfly as well as the narrow butterfly. And here's the side-by-side comparison. So I'm just going to go down the list here for the butterflies, since that is what we discussed today. The trade structure is 3 or 4 legs. The commissions at TradeKing would be close to either $41 or $46. When are you going to open this trade? Somewhere between 30 and 45 days to expiration. When are you going to exit this trade? Probably at least 15 days before expiration. So you're going to be in this trade 2 to 4 weeks, but probably not any further. What do you want the underlying direction to be? You want it to be range bound. Volatility, you want it to be declining. And you want the objective to be that the out-of-the-money options expire. The main focus of the strategy is time decay and declining implied volatility. To contrast that to the Condor, the main focus of that strategy was probability. And you'll see why in just a minute. The sweet spot, that's what we call the profit area. For wide butterflies, it was medium. For narrow butterflies, it was narrow. That's what makes the TP that much more skinny, is how far out you spread out the strikes. The wider you make them, the wider the TP gets. Now the risk area, though, for the wide butterfly goes much deeper, and it's even to the sweet spot, so I'm calling both of those medium. And the risk area for the narrow butterfly, though, is shallow, right? It's not, it's a smaller percentage of the overall picture. The potential reward to risk is giving you 400 to 100 on the narrow side, 100 to 100 on the wide side, but the likelihood is what we're talking about here, and that's 50% likelihood of success for the wide butterfly, 20% for the narrow butterfly, but 68% for the condor. Okay, and that's why we're saying the main focus of the strategy for condor is high probability. But what are you giving up for that high probability? You're giving a deep risk area. You can lose a lot more than you can make. Okay, the potential reward on an average condor is you can make 20%, but you can lose 100%. Okay, so you see that difference here. So that's what you're giving up. You're giving up extra reward to get better probability. And finally, the preferred vehicles. Butterflies can be indexed, but if you're going to go wide, that tends to be an index for sure. And then narrow butterflies, you can find ones that are suited for stocks as well. And index here, what I mean, also encompasses the FX options, of course.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.